Hey, this is Cedric Youngelman, your host of the Bitcoin Matrix podcast. Thank you so much for checking out my show, where we have philosophical conversations about Bitcoin and the future of money. Please make sure that you're subscribed to the Bitcoin Matrix podcast. And if you're watching this on YouTube, like the video so that more people see it, and hit that notifications button so that you don't miss out on any new content. This episode with Market Analyst Joe Consorti on how rates lead the dance is brought to you by River Financial. I'm able to produce this show in part thanks to my sponsors, and I'm very selective about who I work with and put in front of you. So I hope that you will check them out and support them. Now, securely buy Bitcoin and purchase hosted mining rigs at river.com. I've been using River for over 2 years because they have incredible customer service, zero fees on recurring orders, and they will help you unlock the possibilities of this revolutionary digital asset. To get started and find out for yourself, use the link in the show notes and get up to $10,000 free when you buy Bitcoin and miners at river.com. Then get your sats off your exchange. My favorite hardware wallet is the Cold Card from CoinKite. It's definitely worth learning how to use it. You can also start by transferring your coins to a simple open dime you can keep safe. You can get a 5% discount by using the referral link in the show notes. Experience the freedom and affordability of cash payments and community-funded healthcare with Crowd Health. Use promo code MATRIX during sign-up for a special discounted subscription offer. Check out the link in the show notes for more information. Bitcoin 2023 will be back in Miami Beach one more time. Education, celebration, and hyper-Bitcoinization will once again be on the agenda. Join us May 18th to May 20th, 2023. Use the code MATRIX for 15% off your tickets at b.tc/conference. And now, let's enter the Bitcoin Matrix with Joe Consorti, where we discuss all the leverage in the system, crypto, mal investment, FTX, the Federal Reserve, and rates.
What is real? How do you define real?
You can't jump into cash. Cash is trash. What do? You get out.
Joe Consorti is a market analyst at the Bitcoin Layer. The Bitcoin Layer is a premium markets research provider covering Bitcoin through a global macro lens. Joe owned and operated an independent contracting firm during college for 2 summers, which generated in excess of $350,000 in revenue before his junior year of college. Joe Consorti, welcome to the Bitcoin Matrix podcast. How are you?
I am great, Cedric. Thanks so much for having me.
Yeah, man. I didn't even get into the tip of the iceberg of your resume. It's quite impressive. Your background here, especially academically, just some of the things you've accomplished. I'd love to hear, a little bit about your background, maybe even pre-Bitcoin, what you were up to, a little bit about this business you were running. What kind of business was it, and how hard was it to get this thing off the ground?
Yeah, absolutely. We can get into it. So I'm from the Northeast United States, and I went to a relatively local college, 3 or 4 hours away from where I'm living currently. And during my first semester, I was studying biology, actually, and I ended up transferring from biology into business. The reason being is because all throughout high school, I had similarly intended to go pre-med, but I figured out for whatever reason that business was sort of the avenue that I wanted to go down. Freshman year, there was a business club at my school. It was relatively small, 10 or 20 people. And we essentially did business case competitions. And so we were given hypothetical scenarios. We were asked to solve them. And myself and a few friends of mine and a few faculty ended up growing that club from 10, 20 members to now 150, 180 members as of this year, obviously no longer in high school. And essentially, we're one of the best, competitive schools in the state for this business competition. And so throughout high school, that's what I did. I did the president, and I did all these other things. And then I get into college, and I figure, okay, I did all this business stuff, but I'm gonna do medicine. I did 3 or 4 intro level medicine courses. Not for me at all. I can retain all of it, and I could go through the motions and do 8 years of medical school. But I figured, okay, if I did all this business stuff in high school, and I had a passion for it, then I may as well pursue business instead. And thankfully, that was the right decision. So fast forward to the second semester of college, we get sent home for COVID. This was during spring break as well. So I was pretty jaded because I had only brought an overnight bag for spring break, and they sent us home for COVID. And being in the Northeast, of course, these schools are unbelievably stringent when it came to this virus, right? And so we weren't allowed back to get our stuff from the dorms. And unfortunately, my stuff included my computer that I left there. And so I was extremely jaded. I was jaded at the school. I was jaded at the faculty. And I began developing more of, this the level of skepticism, this adversarial thinking, that sort of led me eventually toward Bitcoin. Later that year, is September, October timeframe of 2020. My friend Tyler, who works at Bitcoin Magazine now, who actually competed with me in a few case competitions, he sent me The Masters and Slaves of Money by Robert Breedlove and The Bullish Case for Bitcoin by Vijay Boyapati. And I read both of those, and that's how I dove down the rabbit hole initially. Tyler had known me to be somebody who'd probably be interested in those things. And so thankfully he sent them to me because I was aware of Bitcoin, but just on the periphery of my existence. It wasn't necessarily something I was looking to pursue and become an analyst for full time. And so through him sending those to me, that's how I initially discovered Bitcoin. But again, I didn't really do a whole lot with it at that point. The summer prior, I mentioned I got sent home for COVID. I was jaded at the school faculty. I figured, okay, there are a couple things I could do. I could pay all of the attention in the world to my Zoom classes, right? I could really, really go hard at these, or I could realize that they are on Zoom. My resources are probably best spent elsewhere. And so there's a firm called Collegiate Entrepreneurs, and essentially they give you startup capital. They allow you to run your own business. They pay you with a mentor. And I got paired up with an individual who ran a painting business. Similarly, I wanted to test out my entrepreneurial chops. I ran a painting business the summer prior to me discovering Bitcoin. And I did $102,000 in revenue roughly. And that was extremely fun to get off the ground. I mean, New England summer begins April-ish timeframe. I was already pounding the pavement in February, going door to door. That didn't work out tremendously, but it does put some hair on your chest because cold calling, introducing yourself. Some people slam the door in your face right there. Sometimes you can get through the full speech and then you have to objection handle when you clearly know they're not interested. And so you work your way up from there, and then you build this thicker and thicker and thicker and thicker layer of skin in this salesmanship, and this ability to move through resistance and move beyond friction. And what I ended up doing was, after COVID hit, in March of that year, I began pivoting entirely to basically online marketing. And so I would do targeted Facebook strategies. I would also hire sophomores in high school that had just got their cars, and I would pay them $10 an hour, $15 an hour to go out and just tag mailboxes with flyers. And so those are basically the two marketing methods that I used that ended up getting me all the leads I needed. I ended up selling all the work. And then, I had a cabal of painters, the majority of which were my friends, they're close acquaintances. And then I managed them over the course of the summer. And so that's how I did, the business the first year. The second summer, it was largely the same, except I decided to scale that operation up. And I ended up doing it all across the state rather than just in, the 4 or 5 towns that were surrounding my hometown. I expanded it statewide, and I had different managers that were responsible for different areas of the state. And that went well. I had some attrition, which again, these are lessons that I'm very happy I got as a 19-year-old, because I feel like if I was responsible for which, over at TBL, we're beginning to, expand our operation. If my first experience with managing people was now, I don't think I'd have a great go at it. If my first experience managing people was at 30, then I don't think I'd have a good go at it. I'm really, really happy that, even though I was working really hard, I was pulling, 80, 90-hour weeks, sometimes more. Over the course of the first summer. Then the second summer, I got a little bit more optimized. But running those two large businesses, I'm happy I did it in the way that I did. I'm really happy that I did it at the time I did, because it showed me the utility of work ethic, and it showed me that if I put my mind to something, I set a target, and then I actually work a plan in order to achieve that target. We're capable of crazy things. We're capable of anything. And so I figured out, like, the world's in the palm of my hand, right? Not in an egotistical way, because those 2 summers broke down my ego tremendously. But what I mean to say is, if you have a plan, you set out to do it, you can execute anything. Really, if you put your mind to it and you put the best effort forth. And so that's what I spent those 2 summers doing. And at the same time, I was reading and learning about Bitcoin. And lo and behold, I had a lot of capital to deploy after that first summer and after that second summer. And so steadily accumulating, learning about Bitcoin, learning about markets in tandem with it, all the while running these 2 businesses. That was basically the story of my final 2 years of college, or excuse me, my first 2 years of college. And then my third year of college, I decided to make it my last year, because I figured I'm so close to graduating, I could pile on the credits right now. I could take as many in-home or over Zoom classes as possible. And that's what I decided to do. I decided to truncate my college experience, graduate 1 year early. And at the same time I was doing all that, piling on those credits and what have you, I was doing some more case competitions, but I was also spending basically all of the remainder of my time reading books, conducting research, staring at charts till my eyes hurt, and going out and publishing my research independently on Twitter. And, you fast forward me several months, trial and error, doing research, publishing it on my own on Twitter. And through the grapevine, I got a DM from Nick Bhatia, and the rest is history. He wanted to have a research associate to come on board with him and help him out with expanding his hobbyist publication, what it was ostensibly, the Bitcoin Layer, into a full-blown markets research outlet. And that's what I was brought on board, and that's what I'm doing today.
That's a fantastic story. Makes me think of a lot of things. I think, around that age, it's kind of great to be jaded and think adversarial. I also think about when I was in college, I was a finance major, and I geeked out on a lot of business case studies and presentation groups and leadership clubs. And what I kind of marvel at, though, is just around then, so much brain power was going to the financialization of the economy. It was sort of the beginning of the transition to .com, and then brain power was going there, and it ebbs and flows. I really excited for the brain power that's getting turned towards Bitcoin. I don't think it's coming in droves yet. I don't think that's where I'm guessing the majority of university students are. I think a little bit about, I did enjoy college. I did work hard and at it, but then I think about it, though. A full load is what, 15 credits, 15 hours a week of in-class time. And yeah, I think it's awesome that you sped it up and got it done. I think that's, in a way, incredibly low time preference, and you get your life back and can move on to more productive things. But I fell into the allure of going the full 4 years and really enjoying it as well. And I think having a low class, 15 credits made that easier. But I'd love to hear what's going on at the Bitcoin layer. What kind of things you guys are focused on, and what kind of things that you kind of watch in the markets.
Absolutely. So over at TBL, it's Nick and I, and then we also have started expanding out onto a social media presence. We've brought on a clips creator, and we're bringing on a social media manager. And we've had a designer for several months that came on right around the time that I got on board. And we've expanded. We've moved from just doing a Substack publication every so often to doing 3 Substacks a week, 2 paid, 1 free, every single week. On Saturday morning, we give you a full rundown of all of the markets. And at TBL, we have this global macro framework that we liken to a watch. So when we're talking about what we take a look at the Bitcoin layer, like what it is I actually spend my time doing. Well, doing a lot of charting. I've set up, all of my software that I have on my computer in such a way that it's very simple for me to pull up, and then I have a full suite of everything that I take a look at. And everything that I take a look at, top to bottom, is first things first, rates. And I say rates, but what I mean is the suite of U.S. Treasury rates, right? So all the way from 1 month, relatively illiquid, to 30 years, and along that curve, the key tenors that we take a look at are 2s, 5s, 10s, and 30s. And when we say 2s, we mean the 2-year yield, right? It's just truncated bond lingo, 2s, 5s, 10s, 30s, and so that's essentially what we look at first and foremost, because U.S. Treasury rates, the U.S. Treasury market rather, is the most deep and liquid global market for collateral, right? Banks hold these on their balance sheets, and in order to fund themselves in the near term, they post these as collateral in the repo market and borrow against them. And they're the most deep and liquid form of that. So banks use it to meet their short-term funding needs. They're perceived as the most safe haven asset, in traditional finance, despite the obvious fact that they are being inflated. That we have negative real yields, negative yields in nominal terms for ages now, or real terms rather, for ages now. They still are considered, the risk-free rate proverbially. And so that's why rates lead our thinking. And they're basically sort of the gears inside of our global macro watch. So this isn't actually a global macro watch, just the watch I have on. But if you'll think of the rates market, the U.S. Treasury market, because all along the curve, right, every single rate is a benchmark for borrowing in the real economy right around that tenor. So for example, the 3-month rate and the 2-year yield, those can be interpreted as policy rate expectations, because those are two short rates, and the Fed funds rate is an overnight interbank lending rate. So it's also a short rate. So when the Fed sets Fed funds, you can take a look at the 3-month yield, the 2-year yield, and basically everything below the 2-year yield, and take that as forward Fed funds expectations. So that's what the 2-year yield sort of acts like. The 10-year yield, that's used by a lot of firms, by a lot of banks, and other institutions that write and receive loans as the key benchmark rate. The U.S. 10-year yield is the most liquid along the curve. It is the key benchmark rate for the global economy. And so that can be considered sort of the base rate for a lot of corporate debt. A lot of corporate debt is issued at a spread denoted in basis points to the 10-year yield. And because of that, we tend to think of the 10-year yield, because it's used so critically and so universally by firms as a benchmark rate, as growth expectations, as forward growth expectations. So as that is rising, there's a higher demand for credit by these firms that are borrowing on a longer time horizon. If the rate is going up, obviously there's more demand for money and credit. There's more demand for activity. The idea is that there's more growth in the future. And then vice versa, what we're seeing now is the 10-year yield declining pretty rapidly, because the market assumption is, well, growth is probably going to slow down. People who buy the 10-year, they're falling, they're flying into, they're bidding it up right now. So the yield is falling. And that's essentially why rates lead a lot of our thinking. If you think of the global macro framework as a watch, then, rates would be the gears of the watch, right? So this underbelly right here, not the beautiful bezel, right? Not the beautiful bezel, not the beautiful, band around the wrist that everyone likes to look at and look shiny. Nobody likes looking at rates. Nobody likes talking about rates unless you're a rates guy. If you're a rates guy, you love rates because they dictate absolutely everything. And so that's why they're at the forefront of our thinking in trying to tie global macro to Bitcoin, right? Because we love Bitcoin. It's in our name. It's on my shirt. It's on that big neon sign back there that wasn't cheap. It's on the Bitcoin white paper that's sitting back there, and half the books that are on this shelf. We love Bitcoin, but we understand that right now it exists in a world of other assets, and it is influenced more than most assets by the Federal Reserve, by this suite of interest rates. And so that's why we have these things lead our thinking, because we understand that Bitcoin is a parallel system, but for now, it's an asset that is monetizing in a universe of other assets. So that's essentially like the first thing that I look at is interest rates.
Well, what's the second thing?
Yes. The second thing is closely connected to it. It's money markets. Money markets, financial markets more broadly. So, money markets would be short-term funding markets, like the repo market, the reverse repo market, to see what the demand for cash is like, what the demand for collateral is like. That gives you a sense of how healthy, lending markets are, what lending activity looks like. And then we take a look over at things like credit conditions, both in the high yield market and the investment grade market. Are they loosening? Are they tightening? All of those things, across the money markets that I just mentioned, and also credit, which would be considered more a debt capital market. Those give us a sense of where we're at sort of in the economic cycle. So those are the second things that I look at. And then the third things are risk. I take a look at risk and then economic data and commodities as well. Because obviously commodities are the input to everything. Everything is a derivative of energy. Everything is a derivative of, copper, right? And so taking a look at CRB, the Commodity Research Bureau index, is the index of sort of all commodity prices weighted and aggregated, and crude oil. Taking a look at crude oil, that's very, very useful to show us where we're at in the cycle. Copper, again, because it's such a critical input to things, and then economic data. So from the United States, every single week we get average hourly earnings and continuing claims, and things like that. And, that gives us a sense of where we're at for the United States economy, United States labor market, things of that nature. We also get PMIs, Purchasing Managers Index, which is a survey that goes out to purchasing managers. And it gives us a sense of where we are at economically in terms of manufacturing, right? There are manufacturing PMIs, there are services PMIs, and it gives us a sense based on how these managers survey, whether the surveys are very favorable and economic conditions are looking up, or whether the surveys are deteriorating and we can extrapolate that economic conditions were headed into a downturn. And so putting together rates, putting together money markets, right? Those funding markets as well as credit, to see who can borrow and at what rate and who is borrowing and who's issuing, as well as commodities and economic data, not just here, but also globally. And then finally, the risk markets. The risk markets are the beautiful, the timepiece that sits on top, the bezel of it all that everyone likes to look at. When you say, I'm a markets analyst, people immediately think, oh, stock market, because everyone knows the stock market. It's the most investor, retail consumer facing aspect of markets that people have access to. And so that's sort of why it's, the bezel of the watch. All of these other components are leading, these risk markets and guiding them where they will go. At the very base of it all is rates, and then rates sort of dictate activity in the money markets and in credit. And then, off of that, it's sort of, and these are all reflexive of one another too, right? So commodities moving, it impacts the economic data, which impacts commodities, which impacts money markets, and so on and so forth. But we tend to see rates as the very bottom of it, and all of it impacts, risk markets, which we sort of define broadly as credit, which I already mentioned, equities, obviously, Bitcoin exists along those things. Along other risk assets, even though we know in the long run, it sort of acts as portfolio debasement insurance, as my friend Lawrence Lepard says, which I fully agree with. That was something that was extremely intuitive to me about Bitcoin from the get-go, and one of the big reasons that I got into it. And then also VIX. So what is implied volatility doing? We've been in a multi-decade regime of central bank intervention, and then they suppress implied volatility because there's this market expectation that central banks are going to stimulate after every crisis. And so they pile on the leverage, they get levered up. And then as a result of everyone being short volatility, everyone basically having this negative reaction to change because they expect the central bank to come in and provide stimulus, then it just makes risk markets more and more and more and more fragile. And the reason we watch VIX as just one proxy for volatility is to take a look at where we are in the cycle. What does fear look like? How suppressed is fear versus is fear fairly priced? And that allows us to also show us where we're at sort of in the cyclical trend. And that's essentially our entire global macro framework. It's a very, very intricate economic watch of hundreds of thousands, if not millions of different gears. And we analogize it this way for that exact reason. And that's essentially what I spend my day doing. I love it. And, I report on it, not only on my personal Twitter account, but also for the Bitcoin layer, through our Substack channels. We do timely research, timely analysis on all of the markets that I just mentioned, and we cover Bitcoin through all of that. So, at the same time that we're covering all of these markets I just mentioned, we're also talking about Lightning and borrowing Lightning and all this other stuff, and how Bitcoin sort of fits in that picture. But long-winded answer, but that's basically what we do.
Yeah, no, I love it. I think of a lot of what we just went over there, or what you went over and broke down, is sort of the science or the running the numbers. And how much of what is going on right now do you think like the numbers look the way they should? And I'm at certain times, I guess there's probably red flags that you would see in the numbers where things look weird. I don't know how often that happens, and does anything look weird now?
Right. So as of right now, we're actually in a stage where a lot of the red alarms that you'd usually see at this stage in the cycle are pretty muted. And this is for a reason. So all throughout the year, the Federal Reserve has been at every single Federal Open Markets Committee meeting, FOMC meeting, they've been raising their benchmark rates, and they influence several rates, primarily the federal funds rate, by very, very large increments. And so the market, because of how much stimulus has been pumped into it, because of the widespread expectation, as I mentioned, of central bank stimulus and central banks coming into for the rescue, right? The market has had at several junctures throughout the year, as the Fed has made these incremental increases in the cost of capital, markets have rallied in the hope that the Fed will switch gears, because that's become the expectation. In 2019, when there was a cash shortage in the repo market, the Fed intervened immediately, the infamous Powell pivot. He pivoted, and they paused their benchmark rate until they felt it necessary, because the 2-year yield and other key short rates were falling so low that the Fed's interest rate policy was no longer influencing borrowing throughout the economy. And so they decided to relent and start cutting rates. And then, lo and behold, a few weeks, a month or so afterward, COVID hits. And so they slam rates to the zero lower bound again. Prior to that, it was, of course, the taper tantrum with Ben Bernanke. He was going to taper the Fed's balance sheet, start removing liquidity from the economy. And then the markets had an absolute meltdown. And it was even more of a knee-jerk reaction then, because prior to tapering even starting, the balance sheet started getting expanded again. And so we're now in a regime where markets are expecting central bank stimulus, but at every turn, the Federal Reserve is saying, nope, not yet, higher for longer. They're using words like forceful, they're using words like until it's done. And so right now, all of the alarm bells that would usually be going off at this level of financial tightness are muted. They're very muted because we've had several rallies, and now that we're approaching the peak of tightness, the market is once again, as it has all year, and it's been very wrong, it's been anticipating the central bank to relent, to pause, to cut rates, to do whatever. And it hasn't occurred yet. And so as the Fed holds at this rate at 4.5% on Fed funds and right around there on all of its other policy rates, it increases the likelihood that as this much higher cost of capital, right, 425 basis points in 9 months, it's now being digested by all of these key markets that I just talked about. It's being digested by the money markets, right? And we're seeing funding costs rise enormously, spreads rise enormously when it comes to credit. And you're eventually going to see credit begin to slow down. Into year-end, spreads have actually narrowed a little bit, but they're going to begin widening again. Credit is going to slow down, right? Spreads are going to begin widening. It's going to be much less desirable for companies to issue new debt. Individuals who have to roll their debt, they're going to start firing their employees instead. That is a function of these spreads being far too wide in order for firms to finance properly. going to begin seeing defaults, which will then have impacts, with their counterparties as well. This impacts the money markets too. Again, this short-term funding is going to grow more and more and more and more expensive for a select group of less creditworthy entities. And we don't know when this will happen. And as of right now, I'm saying it's muted. This activity is muted because of these several false hope rallies, that there's this baked in market assumption of central bank intervention, and it's not happening. And so over the next 6 to 12 months, the market's going to come to terms with, wait a second, the Fed isn't coming to rescue us, at least just yet. And so the phrase has been thrown around, something will break and the Fed will pivot. Well, in a way that's true. I think it's reductive, but I think in a way it's true. Because as this cost of capital, extremely raised, extremely manipulated, gets digested through the economy, you're going to start to see things like, exactly like I said, credit markets begin to slow, funding markets begin to slow, general business activity grinds to a halt. We start to see economic data deteriorate. You start to see unemployment begin to materially tick up. And you may even see, that's just the general growth slowdown. But then at this level of restrictiveness from the Fed, mind you, they're allowing assets to mature off their balance sheet, which is removing reserves from banks at a very rapid pace, which is also lowering the overall liquidity of the economy. And so it increases the likelihood, as the Fed holds restrictive for longer, that something like what happened in the UK in October occurs. And what happened in the UK in October was a collateral squeeze. So UK government bonds were falling at such a high rate. And I mentioned earlier in this conversation that US Treasuries are one of the deepest and most liquid forms of collateral. The UK bond market, called gilts, they're also widely used for borrowing denominated in the pound sterling. And what happened over there was liability-driven investment strategies who hold a lot of gilts as collateral. What ended up happening was the value of their collateral dropped so much that these liability-driven investment strategies were going to have to sell some of their assets in order to meet margin calls on their gilts. And what other assets did these liability-driven investment strategies have? Gilts. And so what was going to happen had the Bank of England not intervened is essentially a fire sale, right? So there's this this feedback loop of the price drops too low on my asset, right? And, around the market, everyone who holds it as collateral, right? I get margin called, so I sell, I liquidate a portion of my holdings in order to cover myself, and then all of a sudden, that downward price pressure, margin calls another guy, he sells too, and this wave occurs across all these LDIs. Now, the danger with that is LDIs make up the majority of returns for UK pension strategy. So UK pension funds, they were running these liability-driven investment strategies, which in normal times, that's fine. It's usually generally really safe. It's a short volatility trade, right? So a short volatility trade means everything's fine. You get returns as long as things don't change. And in the UK bond market, things were changing fast. These things were selling off into oblivion. I mean, there were several days in a row where the yield on this was just ratcheting higher and higher and higher, 10 basis point days, several days in a row. And then disaster struck, right? When nobody knew it was going to happen. BlackRock tapped the Bank of England on the shoulder. Other big entities tapped the Bank of England on the shoulder overnight, and that's when it's an emergency, and said, look, this is about to happen. You need to help us. And the Bank of England relented, and they said, okay, we're going to start an unlimited bond buying program. And as of right now, they've slowed that down. I believe they've stopped it. But it goes to show that when things go wrong, they can go wrong very quickly, because everyone that had that short volatility trade on, and this is the case for the entire world, everyone is immensely short volatility. They're borrowing at extremely low rates and investing at very, very high risky rates, because if you don't, then you go bankrupt. And so that is the global trade as of right now. But the issue is that trade absolutely blows up when things change. And what is changing right now? Rates across the world from global central banks are ratcheting faster than they ever have before, ratcheting higher faster than they ever have before. That's the change. That's what's threatening global financial markets right now. It's the fact that we've accumulated so much leverage every single time central banks have intervened, But every time we accumulate leverage, it's hidden in new places. In the case of England, it was with these liability-driven investment strategies, which again do fine. But when uncertain things happen, when the unthinkable happens, such as pristine collateral dropping in value so quickly, then that's when things go awry. And with rates rising as aggressively as they are, things can change, and things can change very quickly. And so while conditions are muted now, the higher they remain and the longer they remain that way, the more likely that something occurs akin to the volatility blow up that we almost witnessed in the UK. And you can be sure that when it occurs domestically, the Fed will have the same response as the Bank of England did, which is do whatever is necessary in order to save that institution.
I wasn't aware that BlackRock got some sort of bailout in the UK pension situation. That's really interesting.
They were one of the funds that was running an LDI over there, and they ended up presumably, right, because they have such a huge balance sheet, they have a tremendous amount of capital denominated in the pound sterling. Presumably, with the size of their LDI, they were one of the entities that reached out to the Bank of England.
Right, fascinating. I'd love to, if you could explain more about what inversion means and what we're seeing with maybe the Fed funds rate, the 2-year and the 10-year.
Yes, this is another one of our absolute favorite topics, because one of our favorite phrases, I talked about how rates lead a lot of our thinking. One of our favorite phrases at TBL, and Nick coined it. Nick actually, he spent a little bit under a decade on a rates desk. He was trading fixed income. And one of the terms that he coined before I jumped on board at the Bitcoin layer was rates lead the Fed. I think he originally phrased it as the Fed is a slave to rates markets. And then I truncated it to rates lead the Fed, because I think it is extremely apt. And the reason we say that, the reason that we have such a strong focus with rates is that if you go back through time, if you look at the past 50 years, 60 years, and it gets a little bit messy in the 70s and the 80s because of, late 70s, early 80s, because of the unbelievable hiking to 14.5% and then slamming it back down, then the hiking back to 15% and slamming it back down. So if you disregard that, if you look at every single hiking cycle that's occurred since then, since the early 80s, it is paused. The Fed has paused consistently when the United States 2-year Treasury yield has fallen below the federal funds rate. Now, everyone has their theories as to why this is. I think Jeff Snyder from Eurodollar University, he said it best when he said, there are several reasons for why the yield curve inverts, but we literally have no idea why. I'll put up several different theories for you. The first one is that, and it's the simplest one to understand, it's that rates expectations in the future are lower than rates expectations today, which makes sense, right? If the 10-year yield, you lock up your money for 10 years, is at 3.5%, and the 2-year yield is at 4.5%, then you think, okay, well, if I'm locking my money up for 2 years and getting 4.5%, why are people locking up their money for 10 years and getting much lower than that? Oh, because they think that after my 2-year bond matures, there won't be the option to invest at 3.5% anymore. So that's why they're piling into the 10-year. And that makes sense. Another theory is that I mentioned twos represent forward federal funds rate expectations, because they're a short rate. The federal funds rate is a short rate. Twos are very liquid. And so twos track Fed funds. And so like different tenors along the curve are a proxy for different rates and borrowing and different economic events throughout the economy. So twos are a proxy for Fed funds expectations, and tens are a proxy for forward growth expectations. Like I just mentioned, they're one of the most liquid benchmark rates for businesses. And so if that's the case, then you think, okay, twos are policy rate, tens are growth expectations. When twos fall, tens rather, fall below twos, that means the growth of the economy is below the policy rate. So it costs, at minimum, businesses, 2% annual or 4.5% annualized, right? And obviously everyone borrows at a spread, but we'll say, just for the sake of ease, 4.5% annualized to invest, to borrow, to fund themselves, whatever. And the growth expectations for the economy are 3.5%, right? So that's not good. So that means impending economic contraction, which will see rate cuts occur. And so that's one theory, right? And I think both of them are very correct. Now, when it comes to our favorite yield curve, which is the twos Fed funds curve, the reason it is our favorite is because twos represent forward federal funds rate expectations, like I just mentioned. And the reason twos Fed funds is so integral is because it's the market's expectation of where Fed funds is going to be and Fed funds now. And like I mentioned, if yield curves inverts, one of the theories is that there's a market implied expectation of rate cuts. So if twos inverts below Fed funds, it's game over, right? Market expectation that, all right, you can't keep short rates elevated this long. And if you think about it logically as well, if capital allocators are looking at, let's say banks, right? If banks are looking at the Fed and they're saying, okay, I could either, the reverse repo facility, for example, which is one of the other policy rates that the Fed sets. Banks are saying behaviorally, when the 2-year yield falls below one of the Fed's policy rates, banks are saying, I would rather lock up my money for 2 years at a lower rate than lend it to you overnight for a higher rate, right? So that's strange. What are banks saying there? Banks are saying that they expect rates to be cut. Why do they expect short rates to be cut? Who knows? Again, it's about playing probabilities. In the United Kingdom, it was LDIs exploding. Here, we don't know where financial fragility is going to emerge. We can make probabilistic guesses, and we can also make probabilistic guesses as to the severity of those events, but we don't know exactly where those events will occur. But what we do know is that the market is implying a higher likelihood that something cataclysmic will occur that will force the Fed's hand to cut rates, whether that is something in the real economy, like it was in 2020, or whether it's something in financial markets like it was in 2019 with the cash shortage in the repo market. But when twos invert below Fed funds, that's what it is telling you. It is essentially saying that the Fed offers this rate that is higher than another short rate, and the market is buying this instrument that is at a lower yield, right? They're voluntarily doing that. So the Fed is losing influence over monetary policy, becoming less effective, and eventually it's going to have to relent. And so it's indicative of banks and other capital allocators deciding that I'd like to get a lower yield for longer because it's safer than lending to you overnight for a higher rate. And it's also which portends cuts. And it's also indicative that the Fed is losing control of monetary policy, because that's what it does when it sets its policy rates. It tries to influence short-term borrowing costs throughout the economy. And when US Treasury yields are moving in a materially different direction, the Fed's toolkit isn't working. And so that's why every single time the 2-year yield has fallen below Fed funds for the last 50 years, rate pause and then rate cuts have come shortly afterwards.
You're looking at a lot of numbers here, and we're doing a lot of analysis. I'm kind of curious, how much in your analysis work do you look at what is said, what is spoken at these meetings, before the meetings, after the meetings, or how much do you think about unemployment's going up, how the Fed could psychologically respond to that? A lot of this sounds like the players in here, and I know there's so many players that it's so random you can't predict what any of the players will individually or as a group do. But how much do you think about what is said and these numbers and what you hear in conversations and your interpretation of that?
For sure. That's a great question. We analyze it quite closely, and the reason we keep an eye on it is because Fed speak has become so integral to the way that markets function. I mentioned that there is a priced-in market expectation of central bank stimulus. And whether or not I like that, which personally I do not like that, the reality is that markets trade off of that expectation. There is a perpetual priced-in assumption that central banks will intervene. And so language and everything at the margin that goes along with it is really crucial to watch. Traders trade based off of And we're not talking the Robinhood traders with an app on their phone. We're talking obviously the multi-billion dollar market moving sized algorithm traders that they trade off of Fed speak. They immediately download the minutes, and then they analyze and they look at differences in words, and then they decide to go long or short based off that. Also algorithm. There are derivatives on derivatives on derivatives of what the Fed is going to say and what they're going to do and what the federal funds rate is going to be and what this data is going to say. And so because there's this layered leverage and these, this huge swath of derivatives combined with algorithmic trading, combined with this central bank expectation for, they're gonna cut rates this time, they're gonna resume QE this time. Then markets are just like always on their toes. They're like Sam and Caroline. They're always on a little bit of speed, right? Mm-hmm. And because of that, at the Bitcoin layer, we take we're very, very detail oriented when it comes to what the Fed is saying, what they have said. I opened up the podcast by saying Jerome Powell has used words like forceful and higher for longer and until it is done. I wish I didn't have to know those things, but I do, because they're integral to the way that markets trade. And so we keep a pretty close eye on what the Fed's saying, how the Fed's language changes over time.
Awesome. Maybe you could expand a little bit about the VIX and what are the components there, and how do you look at that?
For sure. So I won't get too high level, but essentially it is it was created by the Chicago Board of Exchange. And it is a market that derives implied volatility. So basically the expectation for change that is priced into S&P 500 options contracts. Obviously, higher implied volatility, it means that the option can fluctuate a tremendous amount more than if there is very, very low implied volatility, right? That implied volatility can very quickly deteriorate. Options pricing can get decimated. And so essentially what the VIX is it's this premium on market optionality, because volatility is basically, the expectation of change is one way of phrasing it. And so watching the VIX, when the VIX is extremely suppressed, that tells us, okay, there is increasingly low expectation for change. And that's how the market is pricing itself. That's not good, because if market players are, there's a lower and lower and lower expectation for change, right? Which means there's this increasing amount of leverage that's going into the system that will have a negative reaction off of bad news, like a UK pension crisis, or off of different language from Jerome Powell. Then that's bad. And that can lead to extended regimes of low volatility, which means very low expectations of change. It breeds irresponsible investing behavior, because if there's pervasive low expectation for change, you could be conservative in your investing strategy, but the guy down the street's going to outtrade you and you're going to be out of business. And so by the nature of structurally low implied volatility in markets, structurally low expectation of change, everybody is forced into this game of accumulating leverage and playing it extremely risky. And that suppresses volatility further. That suppresses the VIX further. And what happens is eventually, when something bad happens, then it exponentially increases the severity of that event. And so that's why taking a look at the VIX on a secular basis, so, on a more extended 5, 10, 15-year basis is important, right? We've been in a secular downtrend. VIX it's more suppressed more consistently than it ever has been before. And so we know that market, this sort of assumption of no change is proliferating throughout the market, but also at a time when things are changing faster than ever before, with the Fed and other central banks hiking rates extremely quickly. I mentioned that was the issue in the UK. Everybody, they were in these liability-driven investing schemes, not schemes, they're strategies, right? They're legitimate, but they're only legitimate insofar as things don't change. And it's even worse if they change quickly. And that's what happened in the UK. That's what happened there first. liability driven, the first two words in LDI, obviously that implies there's a lot of leverage being undertaken there. And there was. And domestically, taking a look at the VIX on a cyclical basis, to see when it moves above 30, which is considered, overbought, and then moves below 30, which is considered oversold. It just gives you a sense of where the stock market is going to move cyclically. And so that's sort of a tool that we use on occasion, right? But for me, the more important thing is this secular regime of the suppression of the VIX. And the suppression of the VIX comes from what I've been talking about a little bit for the night now, which is this priced in assumption of central bank intervention, which leads to riskier and riskier and riskier and riskier behavior. And the conservative investors get wiped out because your guy, your neighbor down the road next to you is making your returns and then some. He's making double, triple what you're making. You're going to go out of business if you don't trade the way he's trading. So you pile on the leverage, the regime of volatility, and it's not just the VIX, but the VIX can be a helpful measure for this. Gets lower and lower and lower and lower, and everyone thinks it's, you've heard the phrase, everyone's heard the phrase, people think that it's going to go on forever, and then the music stops. And that's what happens as volatility gets more suppressed and more suppressed and more suppressed and more suppressed. And then when liquidity gets sucked out of the system, it's all the more fragile because everyone is positioned like nothing's going to change. Then all of a sudden, things change very quickly. Change is bad when you're in a structural low volatility regime, and change is even worse if it's occurring quickly during a low volatility regime. And so that's essentially what I mean by taking a look at the VIX as a proxy, but also more generally the behavior of investors all around the world. That's essentially what I mean when we're talking about volatility more generally.
Thank you for that. What are you thinking about in terms of, you mentioned all this leverage, and we're just leveraging layered up, it sounds like. Going up another layer beyond even corporate debt, what do you think, what's going on with sovereign debt right now? And how do you read that or look at that?
Right. So I actually just bought a book today, and I posted a photo of it. It was The Economics of Sovereign Debt and Default. And it's right next to Principles for Navigating Big Debt Crisis right there, which is another great debt book. But when it comes to sovereign debt loads, they're higher as a percent of real productivity, real economic value in the economy than they have been ever. And historically, no nation has survived when their debt to GDP is, I believe there's a mark like over 150 or 160%. No nation has survived when that occurs. In the case of Norway, I believe it was, following the great financial crisis, they decided to take the hit. They decided to take basically take it on the chin, whereas every other central bank decided to buy distressed assets ad infinitum from banks, whether it was basically monetizing, pardon my French, dog shit when it came to MBS and all this other stuff, all this other junk from banks in order to bail them out. And essentially what they were doing is they were pushing the fallout from risky behavior further down the road. They weren't eliminating the fallout of risky behavior. They were pushing the consequences further down the road. And that's what we've seen with every single central bank following the great financial crisis. Whereas I think it's Norway. I could be wrong. Could be Finland, one of those countries up there that is, shaped like an arm, very cold year round. One of those countries. But they are doing well relative to Europe. And that's because they took it on the chin since 2008. No other sovereign has chosen to do that. What we have done instead is monetize public and private debt more so than we ever have. And as a result of that, our debt to GDP globally is higher than it ever has been before. Central banks have become, when it comes to sovereign debt, central banks have become the largest marginal buyer of their own government securities. In the US, obviously, that is the US Treasury market. And it's less severe over here because we have the benefit of being the global reserve currency. And being the global reserve currency, when you're borrowing, when you're lending in dollars, dollars are one side of that trade. And oftentimes, US Treasuries are one side of that trade too. to post as collateral and also to hold on your balance sheet, because there's no other market where you can hold that kind of cash and get a return on it without it burning a hole in your pocket. And so there's a structural demand for treasuries abroad. And so the United States Federal Reserve has, through its QE program, it did buy obviously billions and billions and billions and billions of US treasuries all the way along the curve. But we have it better than most because there's a structural demand for these things abroad. The same cannot be said for example, Japanese government bonds. Over the last 22 years, I believe in 2001 or 2002, the concept of quantitative easing was introduced by the Bank of Japan, which is quite funny because we don't have quantity money. We have credit money that can be lent into existence out of thin air. And so buying government bonds from financial institutions, usually banks, and giving them quantity money, giving them bank reserves in order to encourage credit growth, well, it doesn't really do much of anything apart from suppress interest rates and also drive other buyers out of the government debt market. And that is what has happened in Japan. Japan is now the largest marginal buyer of the entire 10-year sector of bonds. It owns almost all of them. I think some studies that have come out recently say upwards of 90 or 95% of government bonds are owned by the Bank of Japan. So that bond is useless, right? No investor wants to hold it, right? Because your yield is, wherever they're locking it at, obscenely low, lower than inflation. And there's no utility in holding it on your balance sheet as collateral because nobody transacts in the end. And so for the Japanese government bond, it's game over. And for countries that do not have the blessing of being the world reserve currency, that's what's going to happen to them too. And that is slowly what is happening to them. The Bank of England, before even starting QT, they initiated that bond buying program over in England. And so now England is becoming, once again, the buyer of last resort for its government debt. This artificially suppresses interest rates. This introduces liquidity into the market that wouldn't otherwise be there and drive out free market liquidity. And so over time, these governments, these central banks become the largest marginal buyer of their government's own debt, right? So they purchase that debt and monetize the debt. And so essentially, the government is being lent to with money from a separate financial institution, right? The Federal Reserve isn't federal, which is nonsense. If they're not federal, they're certainly conjoined twins, right? If they're not brother and sister, they're certainly conjoined twins, right? They have such a close relationship. And while it won't happen in the United States, at least for several decades, because of that structural demand I spoke about, it already happened in Japan, and it's going to happen to other sectors along their curve. It's happening in England. And so what has to occur now? What are we seeing? Well, the Norway way of these extreme debt burdens, getting out of these extreme debt burdens, is just taking it on the chin and then having a decade or two or however long you need of austerity, and it's painful, and you're going to have unbelievably high interest rates. Business growth is going to grind to a halt. But at the end of that period of austerity, economic reality will once again be imposed, because economic reality is stripped away when governments become the largest buyer of their own government debt, right? Rates get artificially suppressed. Projects are pursued by virtue of cheap money rather than them actually providing economic value. The amount of Facebook employee videos where the person goes into work and then they go to the yoga room and then they get a matcha latte and answer emails on the roof and then leave. That's the kind of behavior that doesn't exist in a regime of actual interest rates that are set by the free market. And when the government becomes, when the Federal Reserve or when any other central bank becomes the largest marginal buyer of their government's debt and artificially suppresses rates, that's what you see. That's the kind of behavior you see. You see the misallocation of capital. And so there are two ways out of this for these nations. They could either continue monetizing their debt and being the sole buyer of their country's debt and funding them with printed money, or they can allow inflation to run hot, 3, 4, 5%, over whatever yield, whatever the yield is on that government debt, and inflate away the burden for the government, or they can go through periods of austerity, where they allow real productivity growth and interest rates rising to wipe out the poorly capital allocated players who can't finance at a rate that isn't artificially suppressed. And that means a return to economic reality. But will that happen? No. At every turn where we've had the ability to do that, coming off of a crisis in 2008, we could have allowed the players who got caught up in that, who had all these distressed assets, to unwind. And the implications of that for the United States would probably still be, we'd be reeling from it today, and probably for another decade, because these instruments in the United States was so integral to the world financial system. We probably would have destroyed global financial markets for at least a decade, if not two, if not three, right? And that would have been painful, but it's necessary. It's necessary to clear out that awful, awful undergrowth and this distorted economic reality that we have. That austerity is necessary. And so if that doesn't occur, which it hasn't at every single turn, QE1, QE2, QE3, QE4 following COVID, and soon to be QE5, then eventually you're not fixing the problem. I said this a little bit earlier. You're not actually removing that risk from the market, right? There's pent-up risk, and then volatility spike, that risk blows up. Through central bank stimulus, you're not removing that risk from the market. You're just transposing it through time. You're just pushing it out into the future. You're kicking the can down the road. You're introducing what will inevitably be higher debt to GDP as productivity stays stagnant, but debt continues ratcheting up as this government debt continues being issued and continues being purchased by the central bank and not the actual market. You see productivity continue to decline and decline and decline. You see wealth inequality continue to become more disparate and more polar. And that is ultimately what happens until it can't happen anymore. And the form that unraveling takes many different forms. But ultimately, that's the end game. It can't continue forever. Governments can't continue having their respective central bank buy all of their distressed assets. And the central bank really has to man up and say, look, we are federal, right? We're not going to buy distressed assets from these banks anymore. We're going to allow risk to unfold in the free market. And if it unfolds in a systemically threatening way, then it has to unfold that way. That will be more positive for the United States and the world. But unfortunately, at every juncture, that hasn't happened. And so we are in for a mass unraveling, either extremely inflationary or extremely deflationary within the next several decades. And the longer that it takes for that to occur, the more severe it is. The way out is austerity and real productivity growth, but that's painful. And we've never chosen the difficult route.
Yeah. I mean, as a student of economic history, or especially recent history, that's obvious. So I want to switch a little bit, zoom in a little bit here, and then, talk a little bit about the great financial crisis, 2008. But is this crypto's, and I use crypto here almost derisively, but is this crypto's Lehman moment?
I hope so. I certainly want it to be. I think Dylan, he said it several times, and he puts it so well about how send Bitcoin's price as low as it needs to go, suck as much global liquidity out of the US dollar capital markets as there need to be for all of these Ponzi schemes to become insolvent. And that's what I think too. I think that needs to occur. We need to allow risk where it's poorly allocated to wither and die. Because if not, then it proliferates and we're kicking the can down the road and we're making it harder for Bitcoin later in its life to survive and prosper. Obviously, Bitcoin is this entirely separate asset from crypto. At the Bitcoin layer, crypto perpetually lives in quotation marks because and the funny thing is too, if you ask a lot of crypto proponents, you ask them what it means, what their truncated term means. What is crypto? They go, cryptocurrency. You go, well, yeah, what's crypto? They go, well, cryptocurrency, right? Cryptography, right? And when is cryptography useful as it pertains to money? Verifiable ownership, verifiable digital ownership, right? And that only exists in Bitcoin. Bitcoin is this beautiful combination of several different technological innovations that are working in confluence and had a quiet launch. So now it's fairly distributed, and it's extremely hard to kill, and increasingly so, right? The utility of blockchain only exists insofar as as that distributed ledger is distributed. And unfortunately, in the case of all of these VC startups that attract hundreds of thousands of dollars simply by using the word, none of it is actually decentralized or sufficiently distributed. The only use that a blockchain has is verifiable ownership digitally. And, there's no utility to a blockchain if it is not sufficiently decentralized. Literally, the only utility of a blockchain is that which Bitcoin uses it for. There isn't another one, right? That's why it was created, and that's why it exists. So people going, yeah, well, blockchain can, it can solve, what's an example? The medical care system, the healthcare, right? What do you mean? What do you mean it can solve health? Oh, I'm starting a blockchain startup for gaming. Why? What are you talking about, right? And so we've had this unbelievable buildup. And this is this is why we cover Bitcoin through a global macro lens too, because what's been happening for the last 14 years, or discussion for the last half hour, has been about central banks intervening into infinity, artificially suppressing rates. And what does that do? Creates rampant capital misallocation. And what is one of the biggest areas of rampant capital misallocation that has solely benefited from zero interest rate policy? It's crypto. And all of the VCs, and all of the funds that have spun up as a result of crypto, and all of the money that wants to funnel into it. Because we know that VCs love buzzwords, right? They love buzzwords. They don't care about the technology, only if there is a return to be had. And in crypto, there's only a return to be had if rates are locked at zero and if spending is like way up here, right? When it comes to discretionary spending on behalf of a consumer, crypto is literally the last thing anybody would buy. But because we've been in a 14-year bull market where there's so much liquidity and everything is so good for so long, people just end up buying pictures of rocks. And so that's why crypto worked. That's why it worked. It's essentially, one huge carry trade, because these firms that were doing, blockchain for corn or whatever, they were able to borrow, at 1%, 1.5%, 2%, or they were able to raise equity, from these financing rounds. And then you have all of this extreme moral hazard that's in the markets because record fiscal stimulus. People just buy these pictures of the corn that you're selling. You generate a return, but it only exists because liquidity conditions are favorable, because rates are locked very low, so you can fund yourself easily, and consumers are just spending up the wazoo because they have the disposable income to do it. So crypto existed as a result of artificially suppressed interest rates and easy money. The easiest way to put it is easy money. And I think I like to lead in with a more detailed explanation with a little bit of jargon thrown in there, so people know I'm not just yelling at a screen for the sake of yelling at a screen. I'm yelling at a screen because I'm impassioned about why this tumorous growth exists and why it shouldn't exist. And I think yelling easy money is one way to do it, but I wanted to break it down just slightly more technically. But that is why crypto exists. And what are we living through right now? The most aggressive monetary tightening in several decades. So does any of this dog shit that exists, pardon my French, I'm very sorry.
Okay.
Does any of this stuff that exists solely as a result of low interest rates and extreme liquidity pumped to consumers, can any of that exist when the cost of capital is increased more aggressively than it has been in well over 50 years? No. And that's why the first thing to go within months, within 2 months of the Fed's first rate hike, from 25 basis points to 50 basis points to 75 basis points for the upper bound, was Luna. Luna unwound. And what was Luna? It was the worst of the worst. All of these different bucket shops and Ponzi schemes that have failed, have been a result of, obviously they borrowed at extremely low interest rates. They exist solely because of that cheap money. But Luna was the first to fall because it was just a Ponzi scheme. It was just a Ponzi scheme, right? And so that got destroyed first in May. People were going, oh my gosh, this is great. Do Kwon's a maniac. Do Kwon's off. And then before you know it, who was one of Luna's biggest counterparties, Terra Luna's biggest counterparties? It was Three Arrows Capital. And what was Three Arrows Capital exactly? They were a hedge fund that wasn't doing any hedging in hindsight, that existed exclusively off of the blockchain, crypto, Web3 financing phase, where everybody wanted in, everybody wanted a piece of the pie, to the extent that Kyle Davies was able to borrow almost a yard off of nothing but a phone call and no collateral whatsoever. Right? He was able to borrow almost $1 billion off of a phone call. And that's how bad it got. And so this cohort of individuals who run hedge funds or blockchains, and it all just exists as a result of a highly manipulated and suppressed cost of capital, combined with record monetary and fiscal stimulus. And so then 3AC was the next to blow up, right? They were one of the largest counterparties to Terra Luna. Okay, it can't be that bad, right? What can happen from here? Who was also one of the hugest, we talk about carry trades, right? Individuals borrowing extremely short, lending long, borrowing at very, very low rates, and then lending out at a much higher rate. That was essentially what Celsius was doing. And in the case of Celsius, they were highly, highly, highly levered on several different staking platforms and all this other stuff. And one of the things that they were highly intertwined with was Terra Luna, obviously. And then Celsius unwound. And then from that as well, from the Terra Luna fallout, the Celsius fallout, the 3AC fallout, BlockFi experienced tremendous issues when it came to liquidity. And under the surface, this whole time, a little bucket shop derivatives casino known as FTX was experiencing issues. But it was flaunting itself, right? Like a peacock when it gets threatened, right? It was spreading out its feathers. I'm sure there's a word for that. But it was doing that, right? When in reality it was in a pretty fickle capital position. And so they offered to buy BlockFi, and then through time, obviously, it was discovered, the balance sheet leaked, et cetera, et cetera. They borrowed against a vaporware token that they printed out of thin air, and then they collapsed, right? So it started with the Ponzi schemes, and now we are currently at the Ponzi scheme / derivatives / casino / whatever that just collapsed. And ultimately, I certainly hope that if this is not the Lehman moment yet, then I hope it continues until it's fully played out. I hope it does. Because at the end of the day, what was FTX? What was FTT? I already went on the little rant about the only reason this exists is because of artificially suppressed interest rates. What was FTT? Well, it was a token, right? And we say it's just the word token is simply a word. It is vacuous. It means nothing because a token is an equity. When FTX sold FTT, it wasn't equity in FTX. Like some people like BitBoy Crypto will have you believe, right? On several videos, he was going, I think FTT is okay, I'll stop mocking him in case he sues me. But he said, I think FTT is one of the tokens that's going to go up in a bear market. Okay, well, first off, Ben Armstrong doesn't know why crypto exists because of artificially suppressed interest rates. And what is happening right now, BitBoy Crypto? The most aggressive rise in interest, right? The most aggressive monetary tightening we've seen in decades. So obviously something like FTT wouldn't survive. But he, along with many others, and he led his people to believe that FTT was like the equivalent of FTX equity. No, it's not, Ben Armstrong, because what comes with equity? A claim on a business, right? And oftentimes that business isn't a Ponzi scheme either. Right. See, so with equity, you have equity ownership, right? So obviously not as good as debt ownership. You're not going to get a claim on assets in the event of bankruptcy, but at the very least, you have a slice of the business. With FTT, you have nothing. You don't have anything. And that's the same thing for all these exchange tokens. What has occurred because of the VCs reaching for yield? Like I mentioned, everyone in this market that's really short volatility, everyone is forced to lever up and borrow and lend and borrow and lend and borrow and lend, because if you don't, you die. That's the same for VCs. And so what happened with all of these different firms was they spun up a token out of nothing, which people misconstrued as equity, and then they sold it to the users on their platform. This is the case with Celsius, with Cell token. This is the case with FTX, FTT. This is probably the case with Binance, with BNB. I don't care if it has a smart chain, right? It is a derivative. It is an offshoot of Ethereum that is, again, just as worthless as Cell and FTT were, because you sell it to users, right? Users buy it. You pump up your books because you have all this new dollar liquidity on your books. You show that to the VCs and everybody else who wants a piece of the funding round. You say, look at how much liquidity we have. And then you raise more liquidity, right? And then the scheme goes on and on and on. But the foundation of it, right? And this is where we talk about collateral quality, or just the quality of the assets that you're holding on their books, whether or not they're leveraged. That's where it becomes of paramount importance during the bad times. And now that the bad times are unfolding, we're seeing that, wait a minute. Celsius isn't equity. Cell token isn't equity. It's worthless, right? Celsius collapses. FTT isn't equity. It's worthless. FTX collapses. What happens next? As the, for the sake of the global economy, I hope that the global economy is more robust than I'm giving it credit for, so that a Fed pivot gets delayed long enough until, let me phrase this properly. I hope the global economy is very, very robust. But if it isn't, the Fed will have to intervene sooner rather than later. The reason I hope the global economy is extremely robust, more so than I think it is currently, I want the Fed to be able to hold higher for longer, specifically to destroy the remainder of these crypto firms that are peddling this snake oil, these worthless, vacuous tokens spun up out of thin air that exist on blockchains with no utility. People love to talk about utility in crypto. The only utility in quote unquote crypto is verifiable digital ownership, verifiable digital scarcity. Right? That is the only utility, and only all of these components in confluence with each other that make up Bitcoin are what makes Bitcoin Bitcoin. You take one and you put it into your VC firm and you spin up a token off of it, it's worthless. It's worthless. And I want the cost of capital to remain high enough so that all of those, for long enough, to quote Jerome Powell, higher for longer. I want it to stay that way until every single one of these charlatans, every single one of these con artists is completely insolvent. That is my wish. That is all I'd like for Christmas. And throughout this year, it's been the best Christmas gift of all, because we have this beautiful technology that you appreciate, that I appreciate, called Bitcoin, and it's monetizing, while at the same time, there are bad-natured VCs, there are bad-natured founders that seek to latch onto that monetizing technology and profit off of it. They're rent seekers. And I want financial conditions to remain tight enough for long enough to get rid of all of those rent seekers. So to answer your question, perhaps the most long-winded way possible, I think this is a Lehman moment for crypto. And I hope that this Lehman moment continues until it is all worthless.
I hear you. I have the same dream, I guess you could say, but I got a lot of questions here. So when I think about what's going on here with shit coins, and we mentioned sort of gambling, I think it comes out of this hopelessness. And I agree with you that crypto, in quotes, has nothing to do with cryptography, but I think that people are seeing crypto as hope in the way that they can't necessarily have enough to save or a vehicle to save in. They don't feel they do. And they see the world around them, and some people are getting lucky. And I think they know it's all shyster business. I think really they think it's like going to the blackjack table. There's a vig. The house is going to win, but one of us motherfuckers are going to come out here with a bag. And maybe it'll be me, because otherwise I'm going to spend this on beer or on a plastic toy from China or just something that's not going to last anyway. And I think that spirals up all the way to VCs like the Novograds, who are just, again, mile investment, and they have cheap money, and even if it goes south, they might get bailed out, or maybe they make a sponsorship fee, or somehow, or get a next opportunity. I mean, I think of somebody like Mashinsky. It's so weird. Like, he was involved in VoIP technology. He made a bundle, I think, and then he gets involved in a complete scam. It's like, what are you doing here? But I wonder, though, and I think about Lehman. You had Bear Stearns, you had Lehman Brothers, you had Merrill Lynch, and there's sort of a cascade there, but there were choices made. They chose to let Lehman go, it seems like. And then you could even argue that, the people who let Lehman go then got bailed out to some extent. But Do you think anything going on in the crypto world is big enough to cascade into traditional finance and have it be more of a global cataclysmic event? If I mean, the numbers we're talking about, I mean, like I see Madoff as not necessarily like the reason, we had the great financial crisis, but indicative of the times, of the fraud. So I see FTX as indicative of, I mean, they were running fraud on fraud, using customer funds for other things and betting against customers. I mean, it's just complete fraud. But can any of this actually become big enough to do some damage to the global economy?
It's a good question. I don't think so. It's one of my home state senators, Elizabeth Warren's favorite talking points is that it's introducing untold amounts of financial fragility into global. But the truth of the matter is, apart from the people who are highly, highly, highly speculative, the interconnectedness with like big traditional finance players and like the trillions of dollars of size of their capital base is pretty low. When it comes to crypto, I'm playing with my watch right now. I would do air quotes, but I'm fiddling with my watch. When it comes to crypto's total market cap, it's 350, 450 billion, like it's hurting. And the biggest player in the space right now that's left is Binance. And they've got 64, 65 billion on their books in client funds. And so, if they were to go under, and let's say, we'll assume if they did go under, then those 60 billion in client funds would be unrecoverable. Let's say, just for posterity's sake, that 30% of funds were withdrawn from Binance, and at that level, they could no longer redeem withdrawals, and they pause withdrawals. And then let's assume just a similar FTX situation. I don't believe that the unwind of Binance, the supposed potential unwind of Binance, is going to mirror FTX in its severity or the reason why it occurs. But I do tend to think that, we'll say after 30% of the, reserves on the platform are withdrawn, that's, $40 billion, $35 billion. That's not going to do much to global finance. I mean, it's a substantial sum. Don't get me wrong. But by the same token, when it comes to banks, what are banks doing right now? Like they are, they got $2.5 trillion in the Fed's reverse repo facility. They're chilling. They're happy to get that 4.4% annualized on an overnight basis. They love it, right? Banks right now aren't risk takers. That's why, they're increasingly becoming risk takers. They're moving out a tiny bit on the risk spectrum and buying U.S. Treasury bonds. They're incurring a little bit of credit risk there, which is a silly thing to say, and a little bit of interest rate credit risk. I mean, the likelihood of U.S. sovereign default is so low, but banks are playing it safe right now, as safe as you can get it, and they're playing it safe to the tune of the deployable capital that they do have. 2.5 trillion of it is in the reverse repo facility, and that's just a fraction of it. So when it comes to global markets, Madoff didn't disrupt global finance, but it was a sign of the times. It was. I think if Binance were to go under, which is the second largest player, I don't think it would be disruptive to global finance, but I do think that it would portend other things to come. Just like we talk about, why did crypto blow up first? Well, it exists as a result of the cost of capital being low or negative, and also, because of that, the extreme amount of leverage within the system too, it leads to it leading financial markets. Right? Bitcoin, the wider Bitcoin ecosystem, and crypto, they have an extremely low liquidity profile and excessive leverage, more than TradFi. And so because of that, it leads traditional finance in traditional finance market moves. So all of this unwind that's occurred this year, it's just a much more cataclysmic in its severity, but also smaller in its liquidity profile, proxy of what's going to happen in legacy finance next year and the year following. During the growth slowdown, as the Fed holds higher for longer, financial fragility is being introduced into credit markets, eventually in these short-term lending markets too, money markets, and then eventually over to companies and having to raise capital. What's happening in crypto right now is a smaller, in terms of its liquidity profile, but more severe because of its excessive leverage proxy of what's going to happen in global finance, if that makes sense. So it's overall smaller. It's like watching an explosion in an ant farm, right? It's an ant farm. It's tiny. It's not going to do anything. But like, that explosion in the ant farm that is crypto is indicative of like, a few pipes bursting in traditional finance next year. You know what I mean? So I don't think more crypto unwinding will be systemically disruptive, but it is sort of a proxy
Right.
things to come.
Awesome stuff. My final question for you is, any chance that, and I'm talking about Bitcoin here, that we have bear market exhaustion and it decouples prior to the rest of the market in the short term?
Yeah, so in the short term, personally, me and Nick we'll probably refrain from the word decoupling, but Bitcoin leads risk assets in a very big way because of, as I mentioned to crypto, Bitcoin shares the same low liquidity profile and excessive leverage, not to the degree that these crypto bucket shops have, but it does have more leverage interconnected to it. And also these crypto players, they have Bitcoin on their balance sheets, unfortunately. So Bitcoin gets caught up in the mix. So Bitcoin has a much lower liquidity profile than, say, the S&P 500. And so moves in rates, like the ones that we're seeing now, rates are exhibiting topping behavior. The 2-year yield's coming down, the 10-year yield's coming down in a big way. Fed funds is peaking. That could have been the last hike for the cycle at 450. And so that is favorable for risk assets in the near term. Ultimately, if financial conditions worsen, things get extremely tight, and we start to see economic data deteriorate, and the Fed eventually shifts policy, you will know first because Bitcoin will move first. Bitcoin fell 3 months before the S&P 500 topped. Bitcoin topped 3 months before the S&P 500 topped this cycle. The cycle before that, Bitcoin topped 200 days before the S&P 500 topped. And the cycle before that, even further. So it's interesting, actually, because Bitcoin leads the S&P 500 because of its lower liquidity profile. And so it can sort of be, I believe Luke Roman said that Bitcoin is the last functioning economic fire alarm. And I believe that the reason he said it was because of a similar dynamic to what I'm saying here. The excessive leverage and the very low liquidity, and also no buyer of last resort. Bitcoin is a good proxy for where risk markets are heading, right? And so Bitcoin is the first to lead other risk markets. I think when the tide is turning, you're going to notice that in Bitcoin first. And I wouldn't call it a decoupling, but it does lead the legacy markets. I think the decoupling will occur several $1 trillion of market capitalization down the line, probably 15 to 16, probably even $20 trillion. That's obviously a very high Bitcoin price, but I think that's the overall liquidity profile that would necessitate something of a decoupling, because the market capitalization of gold is 13 trillion, but also you got to consider central banks buy gold, and there's a lot of manipulation in gold. So, but gold is also decoupled. So that's why I'm leaving, double the leeway until Bitcoin actually decouples and becomes a risk-off, long volatility asset, because of the manipulation and also the structural demand from central banks when it comes to gold. And who knows if at that point, ostensibly at that point, Bitcoin will also be in demand by large financial entities, whether it's a corporate, a financial, a govy. These larger entities are already demanding Bitcoin, and they're going to be demanding it more. But as of right now, that doesn't displace the dollar. I think at the start of the interview and for the middle third, I probably sounded like a huge dollar maxi, to use Bitcoin terminology. But that's just me reading the financial terrain. That's me understanding that dollars and treasuries have a structural place in global finance. And I tend to believe that's going to exist for another several decades. Bitcoin will monetize in tandem, and eventually several $1 trillion of liquidity down the line, it could become that risk-off asset that we all view it to be now. It could actually be traded that way. But for now, in the near term, when the tide for risk assets broadly is changing, Bitcoin's going to be the first one to move.
Wow. Awesome. I'm glad we got to meet personally at BitBlock Boom. I think we met at a voltage party. We got to chit chat. I was with my buddy Clay. We both walked away fascinated by what you had to share about macroeconomics, finance, rates, and what's going on with Bitcoin. I ran into Nick, your boss, the next day in the lobby of BitBlock Boom. He happened to be, he was on episode 71, The Hierarchy of Money, Economic Dogma, and Monetary Science. I was like, I got to have you back on soon. He goes, no, you got to have Joe on. And I'm glad he, suggested that. And, this conversation was tremendous. I'll leave it to you for any parting words, let people know where they can find you and your work and Bitcoin Layer.
Absolutely. Cedric, it was good meeting you, man. We'll have to, I think I'll see you probably at some point at one of these other conferences down the line. This was a blast, man. I really loved that you gave me the forum to rant. I really enjoyed it. As for where you can find me, where you can find the Bitcoin Layer, go to thebitcoinlayer.com. There you'll find links to our Substack page. Again, if you want to learn more about what I've been saying for a lot of this episode, our Substack is the best place to get it. We offer free markets analysis once a week, as well as 2 additional paid posts every single week. Or if that doesn't tickle your fancy, we have a YouTube channel where we host guest lectures as well as do markets research and educational videos from myself and from Nick, all completely for free. And make sure to follow us on socials too, if you'd like. We're on Twitter pretty constantly, chronically, you could say, at the Bitcoin Layer. I do a daily morning show over there called the Daily Cup of Joe, where I give you a market to macro rundown. And then also on my personal Twitter, at Joe Consorti. You can follow Nick at Time Value of BTC as well.
This has been so dope. Crazy thing is we didn't even get into the topic at hand. Originally, I wanted to talk about the time value of Lightning, so I'll have to have you back, and we'll get into that as well. So thank you so much, Joe.
Absolutely. Thanks, Cedric.
Thank you so much for checking out this episode. Again, make sure that you're subscribed so you don't miss out on any fresh and new content. I'd love to hear your feedback. Leave a comment or send me an email at cedricyoungwoman@gmail.com. Let me know what you think and if you have any guest suggestions. Thank you to Joe Consorti for taking the time to come on the Bitcoin Matrix podcast. I also want to thank our sponsors, River Financial, CoinKite, the Bitcoin Conference, and CrowdHealth for powering the show. Their support goes a really long way to help me put the show out week after week. I'm also able to produce the show thanks to the support of my listeners and viewers, especially those of you who are streaming and boosting the show for sats on the Fountain app. The Boost legend, Eric99, wrote, "Stay humble, stack sats," and boosted my rip with Svetsky 50,000 sats. Thank you, my friend. I really appreciate it. Bitstein, Lawrence Lepard, Susie BDS, Greg Zaj, and Eric Weiss are up next. Stay humble, stack sats, and get laser focused out there. This is Cedric. Peace.